A P&L statement shows the revenues earned and expenses incurred by a company over a specified period of time. It answers an important question. Did the company make a profit or a loss during the period? To answer that question, the P&L statement starts with revenue and then deducts different categories of expenses to arrive at the final profit figure. Let us go through the structure step by step. The first line item in the P&L statement is revenue, also known as sales or turnover. Revenue represents the income generated from the company's core business activities. For example, a manufacturing company earns revenue by selling products, a consulting company earns revenue from professional services, a software company earns revenue from subscriptions or licenses. Suppose a small furniture company sells tables worth $20,000, chairs worth $10,000, and cabinets worth $5,000. The total revenue then would be $35,000. Because revenue appears at the top of the statement, it is often called the top line. After the revenue, we deduct the cost of goods sold, commonly referred to as COGS. COGS represent the direct cost involved in producing goods or services sold by the company. Examples include raw materials, direct labor, manufacturing cost. Continuing our example, revenues is equal to $35,000. Cost of goods sold is $20,000. The difference gives us the gross profit of the company, which is $15,000. Gross profit shows how profitable the company's core products or services are before considering other operating costs. Next, we deduct operating expenses. These are costs required to run the business but are not directly related to manufacturing activities. Examples include salaries of administrative staff, office rent, marketing and advertising cost, utilities, and other administrative costs. Suppose the company has $5,000 in salaries, $2,000 in rent, and $1,000 in marketing expense. Then the total operating expense would be $8,000. At this stage, analysts often calculate EBITDA, which is earnings before interest, tax, depreciation, and amortization. EBITDA measures the operating profitability of the business before accounting for financing decisions, taxes, and non cash expenses. Using our example, gross profit is $15,000, operating expenses is $8,000, so EBITDA is equal to $7,000. EBITDA is widely used in valuation because it helps analysts compare companies based on core operating performance. After EBITDA, we deduct depreciation and amortization. Companies use assets such as machinery, vehicles, and buildings over several years. The gradual reduction in value of these assets is recorded as depreciation. Similarly, amortization applies to intangible assets such as patents or software. Suppose depreciation for the year over here is $1,000. So now we subtract $1,000 from the EBITDA, and after deducting depreciation and amortization, we arrive at EBIT, which is earnings before interest and taxes. In our example, the EBIT would be $6,000. EBIT reflects the operating profit of the company after accounting for cost of using its asset. Next, we deduct interest expenses, which represent the cost of borrowing money. For example, if the company has a bank loan and pays $2,000 in interest, we subtract this from the EBIT. After deducting interest, we arrive at profit before tax, or PBT. In our example, if we deduct $2,000 of interest from EBIT, we get $4,000 of profit before tax. Profit before tax shows the profit generated by the business before paying taxes to the government. Companies must pay corporate taxes on their profit. Suppose the tax is 25% of profit before taxes, it amounts to $1,000. After deducting the taxes, we arrive at the final profit figure called the net profit or net income, which is $3,000. This is the bottom line of the company. It represents the profit available to company shareholders. From valuation perspective, profit and loss statement is extremely important because many valuation methods rely on earnings based metrics such as EBITDA multiples, EBIT multiples, or price to earning ratios. These metrics help investors estimate the value of the business based on profitability. To summarize, the profit and loss statement shows the financial performance of a company over a period of time. It explains how much revenue the company has generated, what expenses it incurred, and how much profit it ultimately earned.